Welcome to the video on breaking the Sharpe ratio. The Python code for this video is available on GitHub. Please see the link below. If you like this video, please subscribe to our channel or give us a like. This would greatly help us to produce more videos like this in the future. The Sharpe ratio is one of the top metrics used by traders and investors to evaluate their trading strategies and systems. It is often referred to as the risk-adjusted performance measure, which gives confidence to investors by comparing the portfolio to a risk-free benchmark. The Sharpe ratio is calculated as the expected portfolio return minus the risk-free return divided by the portfolio risk. However, as we will see in the following sections, it can be ambiguous and may lead to misleading interpretations, the consequence of which may have serious impact on our trading capital. To demonstrate this, let us look at a simple buy and hold strategy for a portfolio consisting of the e-commerce giant Amazon as the single asset. The trading strategy consists of the following logic: start buying at day 3, exit after holding for 60 days, wait for 2 days before begin trading, repeat. To execute this in Python, the first step is to download the price data as shown in the code below. We first import some Python packages and then download market data from Amazon with the pandas data reader. Next, we initialize some parameters and lists we need for the backtest. Remember, you can download the Jupyter notebook with the code from the link below. Now we run the backtest with the code shown here. It loops through the dates and uses conditions for entry and exit, such that we get trades with 60-day holding periods and a break for 2 days after each trade. Note that this is not a backtest to create profitable trading strategies, but rather to demonstrate the twist in the Sharpe ratio. Now that we have generated a P&L curve, we sort the P&Ls from the lowest to the highest and compare that with the original unsorted P&L. Note that by sorting the profit per trade, we are simulating changing the order of the sequence of trades, from the largest losing trade to the most profitable trades. At this point, I invite you to pause and answer the following questions. By changing the sequence of trades, has the mean and standard deviation of the trades changed? Has the probability distribution changed? Has the Sharpe ratio changed? Is it still approximately 0.96 as we calculated above? With your answer in mind, now we plot the cumulative P&L curve, which is one of the foremost important measures traders take to evaluate their trades. Surprise, surprise! Why did we get two completely different curves? The curve from the sorted sequence, the orange curve, showed we lost $1,000 for quite some number of trades and only start climbing back out of the losing trades towards the end. Whereas the other curve showed that we never lost any money from our original capital. From the standpoint of a physicist or scientist, the two curves represent two different processes in terms of thermodynamics and information theory. The blue curve represents a Markov process where the sequence of the P&L is more or less random in nature. That means the outcome of each trade depends on its current state. In other words, the underlying price movements of this particular stock and the broader market conditions at a particular point in time. In comparison, the orange curve represents a perfectly ordered system from small to large. In other words, we can say that the outcome or state of a particular trade depends on the state of the previous trade. According to the laws of thermodynamics, the two curves have different levels of entropies. We can also look at this from an information theorist's perspective, using information entropy, introduced by Shannon in his 1948 paper, A Mathematical Theory of Communication. Basically, Shannon Entropy measures the degree of disorder or information contained in a data communication system. In financial markets, we can see direct analogies to this. Most of the time, the financial data consists of random noise, and in some situations the data is not completely random, but contains some degree of predictability. This is when traders or investors can capitalize on the predictability and survive. Specifically, Shannon Entropy, H, is defined by the formula here where n is the number of possible outcomes and pi is the probability of the ith outcome occurring. To calculate the Shannon entropy for our P&L curves, we need to first convert the data into binary form, the binary bits in a communication system. We are interested in the direction of the movement in the curve, so let's have a look at the pseudocode. If current value is larger than previous value, assign 1, or else assign 0. Let's start with the easy case, the orange curve. Since the data points in this curve are ordered, we will be assigning 1 to all points. In other words, pi will always be 1, as we are certain that for each time step the next data point will be greater than the current data point. Log of 1 is 0, so the Shannon entropy for this curve is 0. How about another extreme case, where the movement of each data point is completely random? This represents a perfectly efficient market scenario. This is also easy to calculate, as pi will always be 0.5. The Shannon entropy for this case is reduced to h equals minus n times 0.5 times log 2 of 0.5, which is 29 for our case, where n equals 58. This is the maximum entropy we would have for our trading data points. For the blue curve, which is the actual P&L we had for the trading strategy, the Shannon entropy will be somewhere between 0 and 29. This is because the probability for the direction of the movement of each trade is neither 1, where we are totally certain, nor 0.5, where the process is completely random, but it is somewhere in between, a real scenario in practice. Of course, the smaller the entropy, the more certain we are with our trades, and more likely to have profitable strategies. We may find this entropy concept perplexing, but what is more perplexing is when we look back at the questions we asked earlier. The answer to all three questions is no. The blue and orange curve have the same Sharpe ratio, mean and standard deviation, and statistical distribution. Can you now see the problem? Completely different systems with different entropies can have the same Sharpe ratio, as demonstrated above. This is due to the fact that the Sharpe ratio only relies on capturing the standard deviation of the trades or volatility. Note that volatility does not equal risk, and the standard deviation is independent of the order of data points. For our example above, one might suffer substantial loss in the process, all of which is not revealed by the Sharpe ratio. To illustrate this concept further, let's investigate two very different instruments, Bitcoin and the S&P 500 index. The figure below tells the price story for the two instruments between late 2015 and January 2020. One can see that, not surprisingly, Bitcoin has a higher volatility than the S&P 500, especially around 2018. Anyone holding Bitcoin at that time would need to have a mind of steel to withstand the roller coaster behaviors. We are interested to see the Sharpe ratio for these two instruments. To do so, let's run a backtest for both Bitcoin and the S&P 500, implementing the simple buy and hold strategy mentioned above. The resulting analyzed Sharpe ratios are shown in Table 1. If judging purely from the Sharpe ratio, Bitcoin is a better investment, as it has a higher Sharpe ratio than the S&P 500. However, looking back at the price curves, Bitcoin went through a bubble bursting phase in 2018. The Bitcoin price dropped 80% from its highest point. This is a dramatic drawdown from the original capital. All this was not reflected in the Sharpe ratio. Traders or investors need to evaluate their trading strategies using a rigorous approach, or at least not relying on a single performance metric alone. As we have seen in this article, different investment systems, for example with different underlying mechanisms or entropies, or price drawdowns, may have the same Sharpe ratios. If one is not performing due diligence or cross-checking, the losses can be substantial. Furthermore, understanding the limitations of individual performance metrics and looking at the problem from different angles may sometimes save investors from dangerous situations. Please don't forget to subscribe to our channel if you liked this video. If you are new to quantitative trading, you might want to check out our Udemy course, Python for Traders and Investors. You can find the link below. All the best and happy trading!